Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and let's move on. We have Feroz Aziz, Deputy CEO, Anandati Private Wealth Management, with us to talk on a lot of topics related to financial planning and personal finance. So, Feroz, welcome to the show. And to start off with first, we are celebrating World Senior Citizens Day today on The Money Show. And let's begin with that. We'll be talking about investment strategies for senior citizens. Now, this is the kind of age where you obviously need to figure out how will you spend the rest of your life, especially if you are someone who doesn't have like regular income going on in this age of retirement. Definitely, Feroz, we cannot have a strategy that fits everyone. One size fit all will not be the case over here, as it is any which ways, when you talk about financial planning, because it's always case specific. But there are some basic rules or maybe some standardized approach that one can take, depending on the kind of risk factor or the kind of financial situation they are into. So what will be your first pro tip?
Kavita, firstly, like you rightly said, one size doesn't fit all. That's why it's called personal finance. And it's something personal finance is ingrained in our day-to-day lives. We need to acknowledge its presence every single moment because there is financial decisions you're taking. Even on a weekend, when you're going to be spending money on a movie theater, you are actually making an expense. So it's an integral part. And there's no one size fits all. So I concur with what you just said. Point two, there's a good news and a bad news. For all of us, because the longevity of a person or human being's life expectancy is increasing, which is a great news. But financially, that means you need to live a lot more after retirement. When we got independence, if I read the numbers right, which seems so startling, Indian male age of mortality was 37 years. Today, we are somewhere around 68, 70 years, and Japan is at about 85, 87 years. So point I'm trying to make is post-retirement, the number of years you will have to live on your retiral corpus is going to be a long period. It's not like 5 years anymore. It's 20 years you have to live out of your retiral corpus. So that's the second point I'm making. Now, the strategy emanating from the second point is that if you have 10, 15 years, 20 years of investing post-retirement, equity can't be ignored even post-retirement. Otherwise, 10 years back, 15 years back, people said, now I'm retired, so equity becomes zero. So now a retired person in the current contemporary situation will have to have equity as a part of his portfolio. So the pro tip is to have equity. It's the proportions which can be different for each of us at retirement, but it can't be zero anymore.
Right. But Feroz, let's also discuss a bit on the withdrawal strategy that you might want to adopt, on the kind of investments you've done all your life. So how can one implement that? I mean, again, we cannot have like one strategy, like a go-to strategy for everyone. But then how should we implement the process of withdrawal?
Kavita, see, if somebody is retiring now, he needs to or she needs to divide their money into three components. One is short-term current consumption of the person as per the expense. Second part is the long-term consumption amount. Third is intergenerational. Some of us could be fortunate that they have money which they have to pass on to their children and grandchildren. If that's not the case, the bucket one and bucket two need to be distinctly, correctly defined. If somebody has got 1 crore of a retirement corpus, let's assume that if there is an amount of 50,000 rupees needed every month, then there is 6 lakhs to be put in a 1-year instrument so that you can consume the 50,000 each 12 months, and then the rest of the 94 lakhs can be beyond 1 year. So you divide it as 1 year consumption, short-term consumption, 5-year consumption, and then it could be long-term consumption and even intergenerational. So that's the second point I'm making. The third point I like to make when it comes to withdrawal, always like to look at put so much money that you withdraw only 6% of it. So 1 crore rupees can give you a withdrawal of 50,000 rupees per month. You may put 6 lakhs in a short-term instrument, but if you're consuming more than 50,000 rupees a month in a 1 year, 1 crore corpus, that means you're eating into your corpus, which is not advisable. Hence, point one is 6% kind of withdrawals are possible. And SWP is a great method to withdraw money, which is far more tax efficient during retired periods.
One last question, Feroz, and then we move on to our viewer queries. Gone are the days when senior citizens, were prohibited from investing in equity. Even at this age, if you think you have a portfolio that's diversified well enough, a certain amount of exposure can be taken, and in fact should be taken in equities.
Yes, Kavita, see, the perception that equity is riskier than debt can also be questioned. Okay, debt is safer because it is perceived to be safer because it does not move in price every day. But I have seen several people who have lost their entire money in debt, but I have not met one person who has lost his entire money in equity. Equity sometimes is safer than debt, not on a daily basis, because a bond can go default, right? There have been some cooperative banks which have defaulted on their FDs, and monies have not come yet in spite of having finished 12 years. And I'm speaking about one specific example. So there, if people thought debt was safe and they lost all the money, equity is considered more riskier, but you can in 12 years never lose money. So that's point one. Point two, what should be the proportions? Let me give some numbers to it. If you have long-term monies which are greater than 10 years, then at least have 30% in equity, 70% in debt. Your average return, looking at the contemporary situation, could hover around 9 to 10%. If it's medium-term goal, then have 20% in equity, 80% in debt. The average return could be 8.5%. And short-term goals put 100% of the money in debt. Short-term, by which I imply 3 years. Have a return expectation of not more than 7.25%. And when it comes to the schemes which a senior citizen can look at, to be more specific in terms of advice, IDFC Gilt 2027 Index Fund, which is a pure Government of India paper, could be a good fund to consider. Aditya Birla Sun Life Nifty SDL April 2027 could be another fund for debt. On the equity side, Canara Robeco FlexiCap, DSP Equity Opportunities, HDFC FlexiCap, Kotak Emerging, and SBI Contra could be the 5 funds which, as per the proportions I just described, could form a part of the equity portfolio.
All right, Feroz. Quickly, let's move on to our viewer queries now. We will be taking Devendra Sali's question. Feroz, I think you have the fund details. There are almost 9 funds in his portfolio, and he says that he's investing 9,500 every month. He wants you to check his fund mix, and also he plans to invest for more 15 to 20 years. So how is the fund mix looking to you?
Yes, there are about 4 funds I would say can just stay put. In fact, 3 funds which he can exit: Mirai Asset Hybrid Equity Fund, Navi Nifty 50 Index Fund, ICICI Pru Small Cap Fund. These are the 3 funds you can consider to exit. There's a rationale for each of them. I personally think if you're investing 10,000 rupees, you don't need a hybrid fund. You need a debt and equity separate. I don't like index funds because beating a Nifty index by the choice of the right combination of funds is a reasonably high probability event. Out of the 384 active managed funds, you can surely get a combination to beat Nifty. Now, ICICI approved small cap fund. There are other 3 small cap funds, which I personally like from a futuristic standpoint. So the funds you can consider to invest in is Franklin Blue Chip, HDFC Small Cap, Quant Active, ICICI Focused Equity, SBI Contra, and Kotak Emerging.
All right, so that's the solution for Devendra. But then, Feroz, I think you've got some tips for our viewers to make a zero debt portfolio.
Yes, see, Kavita, this of course is a very radical thought, comes as a little intimidating concept. But I personally think that if you look at the last several years of history, with our Indian capital market has been in existence for a reasonable period. So we did a lot of study. 1 year rolling return, 2, 3 year, 5 year, 6 year, 10-year rolling returns, and even 15-year rolling returns on Nifty. Which means that if you invested every single day the market opened and removed the money after 1 year, 77% of the times the return was positive. If you invested every single day and redeemed 3 years hence, the 96% of the times you made a positive return. If you did that same thing for 5 years, 99%, 6 years plus, you were always in the positive zone on Nifty in this century. And that's how many number of days? 6,026 days, which is the full centuries, all working days considered. So 100% probability to beat capital and always be in the positive territory. So anybody who has more than 6 years should not consider equity to be as risky as they perceive to be. In 10-year period, if you bought it every day, sold it exactly after 10 years, even the unluckiest 10-year investor has not lost capital for this century of 2000s. Okay, and so similarly, there are for 6%, there are the probabilities for 6% plus, which is the opportunity cost of debt returns, are also very healthy. And on a 6-year basis, 90% chance that you will beat the FD return or the debt return of 6% by investing in equity. So please don't be shying away of even having a 100% equity portfolio at ages of 20, 30, 25, 30 years of age.
Fantastic. I have more questions on this concept and this research that you've done, but then we have our viewer online with us actually, Mr. Krishna. Good evening. How are you doing and where are you calling from, Krishna?
Hey,
Hi. Can you hear me?
We are doing good. We are doing good. And
Great.
I am calling from Narsipatnam. So
all right. Okay, so Krishna, I think we've got your query. Is there anything else you want to add to the question? We have all the details. So can I just proceed? Can I just go to Feroz for a check on your portfolio?
Yes.
All right, thank you. Feroz.
Yes, I think Krishna, see, if you're looking at a 3 crore kind of a corpus in 5 years, the SIP amount needed on a monthly basis would be 50,000 rupees. And at an expected rate of 14%, you will get to a corpus of 3 crores. Secondly, when it comes to your scheme choices, I would say Mira Asset Tax Saver could be considered for an exit, Canara Robeco Small Cap, Axis Nifty 100 Index Fund, Parak Flexi Cap. These are the 4 funds you can consider to exit. And there are several funds you can look at investing: Quant Tax Saver, Quant Active, SBI Contra, DSP Equity Opportunities, HDFC Small Cap, ICICI Focused Equity, Quant Active, and ICICI Dividend Yield. So these are several funds given to you from a perspective of you can consider for the replacement of the 4 schemes which I said. Now, at the age of 37, like we were discussing, Kavita, on the previous topic of can a person of that age have a largely or 100% debt equity portfolio? To my mind, yes, as long as they are mentally prepared to see ups and downs. Equity will beat debt in a country like ours on a 10-year basis. It is practically an impossibility on a growing economy that debt is outbeating equity. You just have to weather the volatility in the short term to be able to realize the benefit of an extra return over debt. So at your age, Krishna, I think I would not waste 30% of my money in debt. I would consider myself fortunate to be living in India in these years of Indian economy.
Which is why we say that you need to plan your finances, get a financial planner for yourself and just align all your goals as per your investment instruments. Before that, do the right kind of homework that you get to learn from our show. Thank you so much, Feroz, for being on the show and helping our viewers with all of this today. Thank you. All right, on that note, it's a wrap on The Money Show, but I'm going to leave you with our WhatsApp number and our email ID where we keep waiting for your queries so that we can do your life financial planning with our experts. Thank you so much for watching. Goodbye.